Hi everybody, come on in, make yourself comfortable. We'll get started in about 30 seconds. Hi everybody, thanks for joining us. We're going to get started in about 20 seconds. Give everybody a bit more time to come in and make yourself comfortable. All right, welcome to your May webinar. My name is Jeff Thurak. I'm a Director of Australian Advice Network and Evalesco, and I'll be your host today. I'm really excited to be joined by two special expert guests. Live and in person with me today is Marshall Brentnell, my fellow AAN Director and Evalesco Director, and also member of the AAN Investment Committee. And live via satellite from the Gold Coast is Troy Theobald, who's AAN Director, AAN Investment Committee Chair. Thanks for joining us, gents.
Thanks for having us, Jeff.
So both of my guests today are award-winning advisors with over 20 years experience, recognised throughout our profession for their investment expertise and also influence on steering the advice profession in the right direction. We've got a lot to talk about today around investment insights, market trends and what it means for you. So just before we get into the conversation, I'm going to move my slides forward here. Just like to let you know that during today's webinar, you are on mute and your video is turned off, so we can't see you or hear you. We would love, though, for you to post any questions, and I do expect we'll get a few questions today, by typing in the Q&A box. So if you see on the screen here, if you click on the Q&A box on your screen, and you can type in your questions, we'll check those as we go through and maybe I'll answer them on the way through, or we'll come back, time permitting, at the end of the session. Most of our conversation today will be about general financial markets and insights. So I'm just going to give you this general advice disclaimer to let you know that even though most people on the call are clients of AAN, at the moment, we're not taking into account your personal circumstances. So what we're talking about today is not personal advice. If you would like to discuss it further, please get in touch with your advisor to go through this in a bit more detail. So to get you warmed up today, we're going to jump straight into a poll and ask everybody to participate. So I'm going to launch our first poll. And the question we want to know is, how are you feeling about the market movements this year? So there has been a lot of noise and a lot of news around investment markets. And so we're just interested to get a bit of a pulse check before we start our conversation and see how everybody's feeling. So it's fantastic. We're about a third of the people responded. Then we're up to half now, which is great. So I'll give another couple of seconds for everybody to respond. Bit of a mixture there.
Even if people are nervous, Jeff, there's some very enthusiastic responses. Great response time.
All right, that's great. We've got most people's responses, so I'll end the poll there and share the results. So the results that you can see up there are that 32% of people on the call today are nervous, uncertain about what's happening. 50%, so the majority of people are calm, have got a plan and they're sticking to it, which is great. And 16% are excited about the opportunities they can see ahead of them. So that's fantastic. Obviously, the aim today is to build on, or I guess ease some of the feeling of uncertainty and nervousness, build on the calm and have a look at where some of the opportunities are. So thank you for participating in that. To kick it off, Marsh, can you have a chat to us? We know there's been, as I said, challenging times, but how has the year started and what's been driving some of these challenges for markets so far this year?
Absolutely, Jeff. So the year certainly has started differently to our experience last year. Last year numbers were typically quite positive in terms of rates of returns our clients experience, what was happening in markets, overall sentiment. I think we got to about halfway through last year, entering into the third quarter, and some inflation started to pick up. Now, the feedback around many of the major economies when this was on their radar was that the expression was that it was transitory. And I guess the longer something stays as being defined transitory, it makes you think that it might be here for a little bit longer. And that's certainly the case entering 2022. Inflation continues to increase over in the United States, throughout some of the European economies. Our numbers have started to pick up, made greater headlines throughout the election campaign, without a doubt. We've got some numbers there on the screen. You can see what inflation is currently sitting at for some of those major economies or regions. The other thing to think about as well is what's happening with interest rates. That's certainly very different because markets respond to uncertainty. And at the start of the year, we started to get more inflation, more commentary around what's happening with interest rates. And that all creates uncertainty. So you start to get some swings in asset prices, institutions making different decisions, and then you throw some European conflict into the mix with the Ukraine. So there's macroeconomic uncertainty, and then you get, I guess, geopolitical or strategic issues, and markets start to teeter. In the Australian market, you also add in the Australian federal election, and that federal elections are always often a cause for give investors reason to pause, to think about what their plans, because they don't know what is going to happen post the election. But to give you some sort of look and feel as to what's happening, under the hood in terms of inflation, like what are some of the key drivers to it? You can see in the US market there, a number of those items really relate back to what's happening to oil prices. You can see that fuel oil's up over 80% over the last 12 months, which is going to really flow through to everybody's hip pocket. Used cars, interestingly, are up. That's obviously because it's more difficult to get imports, supply chain management, and even things as simple as meat, fish, eggs. They're up 14 to 15%. And I don't think that the US market is on their own in that space.
I think most people would be able to relate to that from what they're experiencing here as well. Certainly fuel prices, car market, similar experiences here as well.
Correct. And, I've got some data too around what's happening with interest rates. Interestingly, some of the major European economies are still on negative interest rates. Each of these has started to slowly but surely move. But what is interesting, we always talk about your personal economy, because whilst some of the central banks have only just started to make interest rate changes, the reality is many of the major banks that we have a relationship with had already started to move. So for the better part of 12 months, Australian domestic banks have been moving their fixed interest rates. Variable has only just changed, but fixed had been moving for quite some time. And to give you an example around what's happening in the United States, if we go back to January 2021, they typically take out a 30-year mortgage, as we do, but theirs is fixed for the duration of the mortgage. Now, their rates back then were 2.65%. The average home was selling for about $401,000 US. Fast forward 12 and a bit months, and their interest rates are sitting at 5.25%. So it's nigh on doubled in 12 months, whilst home prices have increased as well. So there's some real change there, which is going to impact hip pockets.
Yeah. Any comments to add on that, Troy, on inflation, interest rates?
Yeah, and I think that's, well, Queensland, we don't have that because, we're north of the border, but as it comes to state of origin, we've just got to get the friendly rivalry going again. But now we're seeing the same effect here. And that the other thing clients have been commenting on is the lovely fuel excise that we did get a supposed reprieve from, as I paid $2.30 yesterday, wondering where in that supply chain this has been pocketed. And the worry is that that I did have a client I was talking to Marshall prior to this who actually brings in medical supplies, and a container that was $3,000 is now $22,000, and that all ends up with the end consumer, and it's not a sustainable rise, but it's an issue of if anyone wants to Google, supply ships off China, and I think a few weeks ago it was 488 sitting there with factories that are closed down at 70%. The 30% that are open are only running at 30 or 40% capacity. So the world's running out of, and I put it bluntly, as stuff. It's running out of everything. To get 2 new car tyres is, as I found out this week and would never have thought in my life, you actually have to send 2 tyres from Perth for a car that's nothing flash. They just don't have supplies, and that's happening in all industries across the board. So that pushes inflation. You've got scarcity there. The painful part of this cycle we're in now is if you're sitting as an economist, they're looking at thinking interest rates need to increase, which it does. But when Marshall showed those inflation rates before there, how much of that is driven by actual inflation and how much is driven by these effects, that they will subside, but when is the $1 million question? Because as we've gone into other slowdowns and the traditionals, if you go to 2000s and some of the previous ones there, or the GFC, economies were running at 1 million mile an hour. Companies were just filling their back storage with everything they could, and they had huge stockpiles. This time there isn't. Nobody has stockpiles. Everything's just in time and barely in time. So, the cycle can reverse faster in that regard, but then there's the physical restraint of goods and services being able to come back online.
That's great. Thanks, Troy. Any on this slide comments around the election, other than uncertainty eased now and perhaps normal transmission resumed?
Yeah, I think in terms of the two parties and their respective platforms, I don't, at this point in time, I don't consider that there was a marked difference between the two of them at the election in terms of their spending priorities and what that means for the budget. Now, obviously, that may change over time. Once the Labor Party are now in government, they get comfortable and they've got a better understanding as to where they want to allocate future capital. But at this stage, I don't think that it's going to have a short-term impact.
Okay.
Yeah, I'd agree with Marshall's comments there, that until they get under the table and we actually know where the land lies, but those other factors are definitely going to have much more of an effect in the medium term.
Okay, so that brings us to some of the key themes which are emerging. So we've popped a few of them up on the screen here. Perhaps talk us through some of those, Troy, about some of the key themes we're seeing so far.
The flight to safety is an interesting one, and we noticed it happening probably prior to March even, and we did make some changes in the portfolio and further reviewing some others there, that we're seeing when people are uncertain people say no or do nothing, and that tends to be the case. So if you're an investor sitting there, they'll either stay with their current strategy, but are they actually looking to invest in companies that are continuing to grow? And that's probably what we've seen, and I think some slides a little bit later, that a number of the managers, they're just not wanting to deliver an index return. They're trying to invest in companies that are growing and are actually moving ahead in the world. And while those companies are still doing that and still delivering their current market, they're seeing share prices decrease significantly. Like a 20% upgrade in profit should be a good thing in normal times, and they're seeing a 20% reduction in share price. And the best example was Beta Shares have an ETF that just does cybersecurity that's down 45%. Now, I don't know a company in the world that has decreased their cyber spend in the last quarter by 45%. So it just shows you've got very irrational behaviour out there, and that flight to safety in Australia is seeing the top 20, which is banks, mining and resources there that we tend to have a lot of, and that's probably insulated Australia to date from some of the pullback we've seen overseas, particularly in the NASDAQ being very tech orientated, and the Dow Jones there as well. But we're certainly moving away from that, the appetite for investments away from that higher growth to defensive. Human behavior is doing that. Investment 101, if you're holding the right companies at the right time and they're now at a 30-40% discount, it is the most opportune to buy. So So your comment, the nervous, calm, excited, we absolutely understand the nervousness out there because we've had more investment committee meetings. We've done more analytics in the last 5 months than we probably previously needed in the last 12 because markets had a very clear direction. We've had uncertainty probably since October, November. And as the situation's changing with interest rates and outlooks and governments, we just need to make sure we're paying attention. And, European conflict popping up there and, you've only got to go back 6-8 months and Fed and our bank saying 2023, 2024, we might increase. We've already seen the US increase. We've seen Australia increase. And the question is how many and when. So, yeah, the timeframes have moved. So, we don't like to be sort of just reacting to what's going on. We want a well-structured, thought-out approach. And we will, when we can see facts and a clear change, such as change in government, such as inflation number coming out 2 weeks ago in the States that was high, that's what we should be reacting to, not the expectation of the expert that had a different expectation 3 months prior.
Yeah, absolutely. Any further comments on those themes, Marsh?
Yeah, just on the bottom two. So obviously, a lot of the focus of investors' attention is what happens to share markets and property markets, but changes to interest rates also do have a significant impact on defensive parts of your portfolio. So whilst interest rates, if they continue to move forward, will be great for investors that are investing in term deposits or perhaps new bond issuances, it can be challenging for existing investors that have substantial investments in secure strategies such as government bonds. Let's just say the government bond that you're investing in is only paying an interest rate of 0.5% or thereabouts, and the government comes out and issues a new one at 1%. Well, the reality is that investors want to move from the 0.5% one to the 1% one. And when that happens, the one that's earning 0.5% actually falls in value. So, some of the decisions we made a while ago have protected clients in that area, but it's something that we're still mindful of in an increasing interest rate environment. And that third point there around the conflict in Europe has really highlighted the importance of, having a secure energy, or rather an energy security policy domestically to ensure that you can maintain flows of oil and petroleum products. And without a doubt, that has flowed through to allocations within portfolios. You've seen certain types of businesses outperform as a result of that. And coincidentally, it has made it more challenging for investors that might have an ethical or a sustainable lens to outperform over the last 2 quarters, because it's energy-related businesses that have delivered really great outcomes. So, and that more of that will flow through in the next couple of slides.
Yeah. So I guess, as Troy said, we're set up to react to real data and actual changes in information. So, which leads us on to the next slides. How are the managers in our investment committee reacting and responding to what we're seeing in the data now?
Yeah, it's interesting that, and to Marshall's point there, I just had some numbers there that when you look at a Vanguard conservative index, so that would be clients who, Vanguard is the largest money manager in the world. They're the largest not-for-profit in the world, being a benevolent, minus 5.26 for 12 months. Their growth index is down 2.62. So, the conservative investor has seen a greater negative outcome over a 12-month period, which is not a normal cycle. You would have very few times in history where that would be the case. You reverse it over 3 months, the growth has seen more downturn than the conservative. So really seeing, factors playing out there at the moment in markets in different areas. And Marshall and I were talking this before. When we're looking for managers, there's sort of a couple of components we'll get to. There's a style component that we want them to stick to their style, and we want a certain style and certain areas that those different styles will outperform. And the second is what the managers are doing. And some of those in the portfolio are very stock specific. They will buy companies. They're just ensuring the companies they're holding are the very best companies that they want to allocate capital to, and that the managers inside those companies are delivering on their promise to shareholders So from our perspective, it's making sure, firstly, the managers are sticking to their knitting. And then secondly, even when they do that, there will be periods where as an investment committee, it's that style that we may seek to move away from. And that's certainly been some of the considerations that we did last quarter. We're looking at the moment as well there. And really just having that broadest possible approach in times of uncertainty to ensure that we're covering off and not taking any too much risk in any one area of the portfolio, because the swing, and we've got some slides after, against some of those growth managers that, if you had have sat here even 3-4 months ago, have had an impeccable track record versus index, and it's not so much has something changed in all these unrelated companies. No, that's a style issue, which we'll address further on.
Yep. Just before I hand over to Marsh, there's been a couple of questions coming through, which is great. So one of them was, I guess, the crux of it was, it looks like there's forecasts from various people about share market returns being under pressure for a period of time that might drag out, but there's lots of different opinions, and, who do we listen to? There's experts popping up all over the place. So, who do we listen to? And I think potentially, hopefully what we're going to sort of, I guess, gauge from today is we're taking different views and then putting them into the mix and forming our own opinions. And that's where, not reacting, not jumping at shadows is really important. And some of the next slides, as Troy just said, we'll sort of take through some of the processes we go through and our managers are going through, and maybe we'll answer that question over the next 10 minutes. So thanks for the questions, keep them coming, but hopefully you'll get the answers to your questions over the next 10 minutes.
I think with that, Jeff, too, that, we get access to the portfolio managers, Marshall and myself there, and the very best ones aren't making predictions generally. They're trying to identify what themes, what risks and what opportunities, and then they'll have a base case. They will have a case B and a case C if this were to happen, if this were to happen. That tends to be the approach of the managers we prefer. We do struggle with those managers that believe they have the absolute crystal ball and this is the way the world's going to be, because we do find that approach can end in situations where they're just not considering all factors. So those that have a more broad approach, as to if China opens up, what would that look like? They'll do the numbers on 3 or 4 different case scenarios. So when situations start to play out, they've got their information and their facts at hand.
Yeah, spot on. So Marsh, talk us through some of the other ways that our committees and the fund managers are responding.
Yes, I think it certainly depends on the fund manager as to what their underlying philosophy is in terms of how they manage money. But first things first, I think it comes down to making sure that, if you are feeling uncomfortable about the experience that we're going through, first things first, speak with your advisor. Have a conversation with your advisor and make sure that your capital is allocated to the right buckets. And back to that analogy around your personal economy, it's really important to make sure that you've got personal cash set aside so that if markets move as they have, and they will do this every other year, sometimes every year, it comes down to how you behave throughout that cycle and how your advisor supports you in that process that will ultimately set you up for better medium and longer term outcomes. And when we, Troy and I in the investment committee, when we speak with investment managers, we really want them to make sure that, they're adhering to their philosophy. They're not changing focus or direction each and every month based on, what they've seen Tom Petrosky or Alan Kohler talk about on the news. And that old expression around Wayne Gretzky, very famous ice hockey player, you skate to where the puck is going. You don't follow the puck. And some of the themes that we've seen, if I go back to when COVID occurred, we might even jump into the next slide here. Where are we? I've gone back. If we go back to COVID and this period here, you can see that there's a reasonably substantial fall both in this portfolio and the marketplace. And what we expect from portfolio managers in times like that is to consider, well, in this pandemic, which are the businesses that might deliver better outcomes for investors and which are going to be impacted. So throughout that period, investment managers were moving out of aviation businesses and a whole range of other strategies, travel businesses, and then moving into other strategies. What we're seeing at the moment, sort of over the last couple of months, some of the partners that we work with, they're allocating more capital to the likes of BHP and some of the big materials houses. And really, they almost look at a BHP as a very low-cost way to access a range of commodities and products that effectively the world will continue to demand and require.
Yep.
And, outside of that, we then expect managers to consider, well, over the next 6 months, inflation is probably going to continue to move forward. Interest rates will continue to move. Which of the businesses do we want, or do they want to allocate more capital to, and which do we not?
Yep.
And that also flows through to the investment committee, some of the decisions that we make. So some of the managers have got a very fixed view and they won't always look through the cycles. Others will be a little bit agile and they can make some fine tuning along the way, shall we say. So this slide here, I've highlighted a couple of sections, and it is really important because it does come back to having a longer term mindset. You can see this is a portfolio that originated in 2002 with $100,000, and over a period of nigh on 20 years or thereabouts, it's grown to just shy of $800,000. Now, there's been lots of dips along the way, and the steepness of that red line towards the end makes it difficult to decipher the size of some of those falls that investors would have experienced each and every year. I've highlighted two. One was at the back end of 2018, I believe it was, and the other one was COVID around February, March 2020. And you can see we're a long way past that point, but that red line has certainly dropped substantially. Now, this manager allocates more capital to software businesses and high growth style businesses, so it is certainly more susceptible to some of those falls. And interestingly, the blue line in the two highlighted sections has fallen at the same level. This time, not as much, because we're dealing with some substantial differences in terms of inflation, interest rate movements. But as Troy touched on earlier, the Australian economy is, particularly the Australian share market, is so dominated by resources businesses, some of the major banks, major retailers, that the flight to safety, that's where investors have gone, if that makes sense.
Yeah, and the heading on the slide is balancing the short and long term. So we're in the middle of the short term right now when you look at that dip in the red line. So we don't know how long that's going to last for, how long it will take to bounce back. What we do know and can have confidence from the slide is over the long term, it will come back.
It will.
And it's just at some point in time in the future, that will be a small blip. Right now, it feels like a large blip.
Correct. I'll often say that the further you stand back from the chart, the blips really sort of disappear. It doesn't make it feel any less uncomfortable at the time, but it's how you manage your experience throughout that time, how you allocate capital, and what the underlying investment managers are doing as well. This slide here is, once again, one of the managers that we work with. And some investors, have often said to us, look, markets have fallen, I might increase my cash holdings and then I'll reallocate capital when conditions have improved. Now, the challenge is that, trying to time an exit point from a market is like trying to catch a falling knife. It's very difficult to do. Typically, you'll probably cause more damage than positive outcomes. And if you were to go back to going from right to left, the second cluster of red lines or red bars is when markets have fallen around COVID. Now, at that time, I'm sure that, Troy, Jeff, and certainly I had one or two calls from clients thinking we should make the strategy much more secure, much more cash oriented. We reverted back to the conversation around cash buckets and managing that. But if investors had have exited at that time, you can see how quickly the green bars have rallied back. And you've only got to miss a few of those months before it's actually cost you material numbers, if that makes sense.
Yeah, and that's a hard thing to when you've been through a few months of negative returns and the outlook is still uncertain. It's a really hard thing to say, okay, now I'm going to take my cash and put it all back into the market. So that's why we talk about sticking to your plan, working through, allowing these cycles to play out. And I think this chart illustrates some of the results of that.
The other point I'd make there on that is, we do with all of the models that we had when we built those was to have the quarterly reweighting approach there, and that fits into exactly that slide that during those green quarters when we're having those nice positive strong runs, we are banking and taking profits and putting that into the defensive part of the portfolio. And then when we do have those red quarters there that we saw last quarter and potentially this quarter again, we're actually buying more shares at a discount while they're down. So we're doing that behind the scenes already for clients. And then to Marshall's point, for the retirees, we have that cash buffer. And if we go back, it's not even that long to December, the reviews, clients are not wanting to hold cash because returns were up 15% on a 12-month period. Now returns are down, or we're seeing some negatives. They're wanting to have more cash, and we've just got to stop that. The reverse is what we actually need, which is why we have clients with those cash buffers in advance, and the wealth accumulators buying through this part of the cycle. It's over that period looking forward, it's the best time for them actually to be buying, as opposed to trying to guess where the bottom is. If we're buying every month, we're buying through this part of the cycle. So it's different strategies from our office's perspective with individual clients, but each client hopefully understands the strategy that's been put together for them is there for that reason, to help them through that period.
Absolutely. All right, we'll keep moving, otherwise we're going to run out of time. Lots of information to still get through. So where do multi-asset strategies fit in the portfolios, Marsh, and what are those managers looking at in recent times?
Thanks, Jeff. Yeah, so there's a lot of talk around what the Australian equities managers are doing, what the international managers are doing. But within each of the portfolios that we run, we have an allocation to what we call a multi-asset manager. And essentially that's a team of professionals that's able to make decisions that are more tactical based on what they're seeing in the marketplace. Now, I'm not sure if you can see some of the detail on that screen there, but there's a tremendous level of, granular detail you can get to in terms of the types of investments that you could make. And, at the current period of the cycle, the multi-asset managers that we work with, typically they've got larger levels of cash, fixed income, and some other derivative instruments in play as a protection mechanism. So whilst the Australian equities and international equities managers might not be moving out of the marketplace, the multi-asset partners can. And they can unwind certain strategies that they might have had positioned for a low interest rate environment and move it into a more agile play, if that makes sense. Is there anything you wanted to add there, Troy, in terms of what the multi-asset managers do?
Yeah, and that's probably our method to getting a little bit of exposure to other asset areas that we probably wouldn't put directly in the portfolio for clients. So we don't like our clients having access to investments that could become illiquid. We, as advisors, I think that the IC, it's well over 100 years experience, and we've seen where those mortgage funds and some of those illiquid assets can have issues. We do specifically, as an investment committee, avoid those as a starting point there, just because when you do have issues and clients want capital, we want that to be liquid and to come back to them. So by the fact of having these multi-asset managers, they can access some of these strategies, but we've still got liquidity for our clients there as well for their direct holdings.
Yep. Fantastic. So while you've got the microphone, Troy, inflation and interest rates, obviously really hot topic throughout the year. Every news report talking about one of these in some ways. I've had some questions as well come through today about the effect of inflation on RBA's interest rate decisions. So can you maybe talk us through a little bit of this theme and how this is playing out?
Yeah, I mean, this is the $1 million balancing act going around the world at the moment. And unfortunately, the black line increasing is something that I think I've been going to investment seminars for more than nearly a decade of them saying they want inflation to increase, and they've been almost begging for inflation. And in the first sign of it, when it's finally come back storming, they're now wanting the opposite. So you're going to see a change in basically what worked the last 4 or 5 years from a strategy or investment perspective. You need to go back to fundamentals and look at histories of the past, which is our job as the investment committee and the managers' jobs as well. That we do know certain strategies will struggle with headwinds with that. The question is how long these cycles last for, and inflation has spiked. It's almost vertical there from as you can see from that. So the flow-on effect is what happens with the interest rate. How much does that increase? How quickly does it increase? And how much is the end game increased by? But as Marshall pointed out, we had clients with 6-month home loans. You're probably only talking 8-9 months ago paying 1.8 that are now 3.8. The banks and the lending system around the world has probably already done a lot of the lifting, and then because the market movements have probably dictated, and then with COVID effects still coming and issues coming out of China with manufacturing, very hard for them to work out what of this component will be sticky and stay, and what will stay for we'll call it a reasonable period, because that's the hardest part as to when those supply chains open up and we get a more normalized scenario, because different components of the world have had lockdowns in different scenarios. China manufacturing was probably working fine, and a ship couldn't go to WA and make its way to Melbourne because we would lock them in one port or both. So each country's had its own issues, but now centrally where things are coming out of is the issue. So until that abates and we actually get manufacturing going, then inflation is going to have pressures all over the place.
Yeah, and you can see on the chart there is often a correlation between interest rates and inflation. And that's where, as you said at the start, Troy, it's that balancing act between how much do the central banks increase rates and what's the data that they're responding to. There was talk about inflation, but it wasn't until a few weeks ago they actually had some hard numbers to say this is actually now a pretty high number. And we'll see that sort of playing out. I guess the other part of it then is people's spending power. So, what are they going to spend their money on, and how much people have been able to save up some money in recent times, and what does that do for inflation as well?
Yeah, that'll be interesting, because certainly the reviews probably up to February there, the retirees were finally getting back to talking holidaying at the end of the year overseas. So the spending habits did look like there was going to be a move from domestic to more travel. And that will certainly change spending habits. But some of these forces at play at the moment, whether that pushes that down the road, because the issue with inflation is then people are having to put costs up. I was in Ocean Shores seeing clients this week. A lot of the restaurants and the little spots have closed because their housing has nearly doubled, the rental has nearly doubled, and the people that are waitressing and those sort of lower end jobs, they just can't afford to even live in the area. So there's going to be a big social impact with that if it's playing out there, it's playing out all around the country. And I don't know what the easy fix with that is, because you need all levels of employment to be living in the local community. And when you get pockets that are purely priced areas out, that I don't know how that easily unwinds from a social perspective.
Yeah, absolutely. Now, you mentioned travel. We're interested in launching another poll just to make sure everybody's still paying attention at home and get your thoughts. So I'm going to launch a second poll, which is going to come up on the screen now. So what's your opinion or thoughts on overseas travel? So I'd love to hear who's planning on going on trips. Have you booked a trip this year, booked a trip for next year, or are you never travelling overseas again? So the results come in. We're about a third of halfway there now. So a few people not travelling, but most people, it's evening up a little bit.
Going to go this year or next year? I reckon most will go next year, and those brave souls have already booked for this year and are tired of being locked up.
Yeah, that's right. All right, so I'll end the poll there and I'll share the results with you. The results there showing 40%, almost 40% booked trip for this year, 35% for next year, and 26% are never travelling overseas again. Plenty of great places in Australia to see, so that's not a bad thing. I know the three of us have all booked overseas trips for this year, so we're sick of being locked up. I think that would fit into that category, Troy. So that'll be interesting to see how that plays out more and more. Moving on, so we've got different investment styles. So how do active investment styles differ? There's been a bit of a talk about rotation to value in recent times, but can you talk us through, Marsh, I guess, what that means, and in the context of recent times, how that's played out?
Yeah, so over the last couple of years, or probably the last 5 to 7 years, the style where you're investing in businesses that are allocating capital and you're expecting to get a return or grow at a faster rate than the broader economy, like far faster. And there was almost this consciousness that it's okay to pay more because you know that the earnings are going to continue to grow like a multiplier effect, effectively. And the balancing act that we have as the investment committee is to make sure that we have, an exposure to different styles, because they're not all going to perform at exactly the same time. And, historically, there's been about 7 years where value managers have performed quite poorly in Australia. And it's also more difficult to have a value style in the Australian marketplace. You can obviously read the description there, but because there are less businesses here, and they are so dominated by resources businesses, major banks, major food chains, and the like. So it is harder for a manager to have, an adherence to the one style. Certainly, we want to make sure that our active managers are investing in good businesses with growing income streams, and they're not too highly leveraged. That's, a consistent experience. Mm-hmm. But we want to make sure that our managers are doing different things. And one thing that's been popping up on our radar more and more over the last 4 to 6 months is 2 of our active managers have almost trended towards this one very heavily correlated portfolio. So that was one of the reasons why we started to make some active decisions to move or reduce some of our exposure to those managers, to give our clients a greater exposure to the dominant blue chips in our portfolios or our business. Mm-hmm. And I think that will continue over the next quarter.
Yeah. What are some of the other styles of investments? And these are some of the ones that may or may not be included in our portfolios, but are sort of, easily accessible and often, or some are talked about. The smart beta one maybe not as commonly talked about, but can you talk us through where they might fit or shouldn't fit?
So typically when we build a portfolio or a model, we want to have some allocation where we're selecting great managers that can select businesses that you can see. So they're actually making informed investment decisions. Yep. Outside of that, though, you can access the entire marketplace. So when you're watching the news and Alan Kohler or Tom Petrovsky comes on, and I've said them twice, but typically they talk about, well, the Australian share market did this today. So you can go out and buy the entire market, either in Australia or overseas, at a very, very cheap rate. So that gives you very broad exposure to what the marketplace is doing at a low cost. So to give you some sense, you could get an exposure to the United States via what is called the S&P 500, which is the 500 largest listed businesses in the United States, for 3 basis points. So, that's, very, very cheap. Yeah. An active manager would probably charge you 20 times that level. Okay. And there's a range of other different investment techniques that we can use, but essentially We try and select active managers that are doing sensible, prudent things, and where we want our investors to get broader market exposure, we try and use what are called exchange traded funds or ETFs, and that has the impact of giving you market exposure, but at less cost. And it's over the last sort of 4 months that the broad market exposure has typically done well. Smart beta has typically done well, which is typically, instead of allocating a percentage to a business based on its size, you allocate, let's say you've got 100 stocks, you allocate 2% to 50 businesses, equally weighted. Yep. So it's a slightly different approach. It delivers similar rates of return to market, maybe a little bit better. But both of those have done particularly well over this period.
Okay. Troy, you touched on earlier about mortgage funds and unlisted investments and liquidity. So I guess maybe you can give us a bit of commentary on listed versus unlisted and where they might fit.
Yeah, and that's probably that listed versus unlisted. Listed meaning that it's listed probably on the stock exchange. It is tradable on a daily basis. So that's really the key, particularly when markets get tough. An unlisted asset will be an asset where it might be, a property fund or a mortgage fund for argument's sake, but a property fund where it's open for 3 months, capital flows in, it might be to purchase 1, 2, 3 properties there, runs for 7 years. At the end of 7 years, there is a vote where it continues or return capital. So restriction is year 3, life changes. How do we get access to that? So that's probably been our version from a model perspective. We need clients to be able to join or leave or access money every day. And particularly with that listed scenario there, we've worked very hard the last 6 years to drive costs down for clients. So through some of those smart beta approaches, some managers had approaches that were as high as 1%. I remember one boardroom there, Marshall and I, when I could be in the same room, when 1.5 metres was, wasn't even a thing, sitting in Sydney, where, they were a very long running strategy. I think it was about 1.15%, and we identified a strategy that was almost 99% correlated for about 35 basis points. So basically a third the cost for clients, and we implemented that into the portfolio. Even the indexes, Marshall, to his credit, they did a lot of work there, even for the Vanguard. We then even looked at their ETFs, what's in their underlying ETFs, and we went that next level up and turned 20 basis points down to 7 or 8. So we've tried very hard to deliver the outcome. Then how can we reduce cost? And then also working with active managers with buying power of more than $1 billion now in the model group there to drive costs down. And our ethos when we established it was 100% of savings go back to clients, and we've maintained that. And probably haven't quite cut the cost in half from where we started, but it's very close. Yeah,
very powerful and shows through. So we've come up against our time constraints, but I think that if anyone needs to go, feel free to go about your business. But we might just finish off the next couple of points we wanted to cover. We will be sending out the recording after the session as well. You'll get that in the next week or so. It'll be available on our website, the AAN Asset Management website. So if you need to go, check the recording for the last couple of minutes, but we'll keep going through the last couple of slides. Some of the key drivers of investments, Troy just really articulated very well around the fees and what can be done in that regard. The other couple of drivers being asset allocation and investor and manager behaviour. I think we've touched on the behaviour of managers and investors throughout time, having those different buckets, making sure those managers are sticking to their style. Maybe we touched a little bit on asset allocation in the multi-sector, but any other comments in regards to asset allocation as a driver of investment returns?
I think probably just the note there that when we built, if we look at the core portfolio, it was to have a 65-35, so 65% growth, 35 defensive, have it reweight back to that each quarter. And we try to remove that asset allocation bias between Australia and international. So a lot of people, they have some blue chip shares in Australia, but the rest of the world is such a larger place where we're not even 1% of the world. So from our perspective, it's having that equal weighting between those. And then the next step down, we even equal weight between managers or approaches inside of those. So some of those value and growth we spoke about before. And we reset that every quarter just to remove some of those bias that can be in portfolios there, just to reduce those risks. So the idea is we can embrace some of those growth strategies that we saw before. You know, they can drop and have those quarters. We're going to buy more of those, but likewise, the last probably 5 quarters, 6 quarters before that, we were selling and taking profit off that same manager.
Yep. Very clearly explained. So before we wrap up, is there any questions from home? We've still got most people hung around, which is great. Thank you for giving us an extra 5 minutes of your time. Last chance to type in a couple more questions for Troy and Marsh before we wrap up. While everybody's thinking about their questions, I think we've come pretty much to the end, but any final comments from either of you? It has been a challenging few months on investment markets in general. Any closing comments on from here?
I'll probably let Marsh do the close, but from that perspective, look, I do understand the clients feeling that nervousness to come, and we've got a process there. Excited's coming, but we just need a bit clearer direction of interest rates to get to that. But yeah, really, it's a case of, you know, from an investment committee perspective, we've spent a lot of time, a lot of years now working together. We've got independents on the investment committee. We've got independent consultants we're getting as well. So we're giving that good, broad, structured, robust strategy there. So we're trying not to be reactive, but we're also aware of, you know, Paul, one of the other directors, Paul Forbes on the license there, you know, he loves saying is, you know, at the Titanic, was it the fact it hit an iceberg, or was it didn't slow down? So we do understand there's periods where we do, you know, we know this is a long-term scenario. We're not going to race to cash and make those types of calls. But if there's certain sectors or areas of the markets we feel we should step back from, that allows us to allocate, you know, capital to other areas to get through those periods. And when things clear, we know exactly where we are going forwards from there.
Perfect.
The only thing I would add is that I think everybody that's listening to this has certainly been investing or have some consciousness of the share market for as long as everyone that are sitting on this panel. You know, we've been advisors since the early noughties or thereabouts. We've been through many cycles, and each time there's this sense that this correction is different, when in reality there might be aspects to it that are unique, but typically, you know, humans and the economy will push through, because each year we typically want to be in a better place than we were the year before. And as long as you are allocating capital sensibly, back to that very boring mantra of your personal economy, you'll be able to trade through this experience. And if you do feel anxious, if you do feel cautious or uncertain, the most important thing is to have a conversation with your advisor, and where possible, ignore the headlines.
Yeah.
I think that's a great place to finish. Thank you, Troy, for dialing in live via satellite. Marsh, for popping in from your desk 5 meters away.
I didn't put my jacket on.
And sharing your insights. Hopefully that's added to some people's sense of calm. And we can start, as Troy said, moving towards that confidence over the next little while and getting more excited. Thank you for your engagement. Thank you for the questions from home, and enjoy the rest of your day. Thanks, guys.
Thank you.